it's pleasing as we stop and survey the last 12 months, all the portfolios across the different risk profiles have again exceeded their return expectations. Across the risk profiles, all generating mid to high single-digit returns. But if we look at what the markets did over the last 12 months, it doesn't quite give a display of great money-making opportunities. Australian equities generated a very, very small positive return, up about 0.6%, and we saw a similar sort of return out of global equities. Australian dollar happened to fall 3.4% over the year, and similarly we saw some pretty solid falls through the commodity complex, including oil, which was down close to 19%. So whilst the emerging markets index fell 9%, our investments into emerging markets were up about 10%, so outperforming the index by about 20%. Similarly, we saw the story in our alternatives portfolios, up about 7% over the year. We had a slightly higher return coming out of our real assets portfolio, and pleasingly, a lot of our equity portfolios outperformed quite materially, generating high single-digit returns. Whilst those headline numbers were flat over the last 12 months, we did see a couple of periods of extreme volatility through the year. The first of those was really driven around the interest rate rise out of the US and the shock that that sent through the financial system. But in addition to that, we really saw the recent events that came out of the end of the financial year, most notably Brexit, throwing a short bout of volatility in the market. The significance of Brexit can actually be quite material. The European Union contributes about 25% of global GDP, so it's actually very important in the context of the global environment. What the referendum's done is signalled to the Tories, the leading political party, that they need to enter into negotiations for them extracting themselves. So all this has done is breed an air of uncertainty, and that uncertainty can actually lead to lower economic growth because companies and individuals withdraw or hold back on investment decisions until the new economic reality or the new trade environment is actually being established. And we're going to be years away from knowing that. So the main short-term concern is just lower economic growth in an already benign or weak economic environment that exists in Europe. We're still expecting global growth at levels that we've seen this year, low 3%. In addition to that, we're really pleased with the positive economic news coming out of the US in recent months, provided other global volatility doesn't present itself. We expect that the US will continue to raise interest rates over the next 12 months in evidence that their economy can support a slightly higher interest rate regime. However, markets are generally fully priced, and earnings growth, which ultimately is the true driver of market returns, we'll see in the low to mid single digits. There remains a large number of risks. There remains a number of economic risks, particularly banking systems in Europe. Chinese recalibrations of their economy, dealing with their capital outflows remains an issue. And the political risks, Brexit was an example we've seen recently, the US election coming up later in the year are other examples. So in amongst this environment, we've taken the opportunity recently to take some of our investment risk off the table, in evidence of the fact that markets are fully priced and that through the year we expect that there will be bouts of volatility, and hoping that through some of those bouts of volatility we have the opportunity to buy into some of these investments that we like at more attractive prices. So in summary, over the last 5 years really we've seen very strong compounding returns being generated out of the portfolios. Whilst markets are fully priced today, and there are always going to be at any point in the cycle risks that surround those markets, we still remain confident that over a similar time frame that we want our clients to look at over the 3 to 5 years, that we can continue to compound similar returns in the foreseeable future.